Hi folks, here we are again on Tuesday evening, and we're just in pre-show mode for a moment or two to catch up to 8 p.m. Nice to see everybody on, and also good to see Tony queued up, ready to come in. The dogs are here, of course, as normal. They've been for their walk and had their breakfast, so they're going to be sitting here and hopefully not making too much noise, although it is bin collection day today, so you never know. And for those who may not know, this is the setup here. Tony Locantro teed up there, ready to come in. As you can see, we've got the multi-view, we've got the chat, we've got other bits and bobs going on, and everything's set up. So hopefully the show will run smoothly. I'm driving it myself as normal, so, anything's possible, but generally seems to work okay. And nice to see everybody on. Anyway, we've hit the 8 o'clock mark, just coming up to it now. So there you go. So by the time I take the pre-show off, we'll be able to start the show and start on time. I'll see you in just a moment. Well, good evening. Welcome to this live stream on the 25th of November, 2025. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thank you for spending some time on your Tuesday evening with us. Really appreciate it. And we're going to have a really interesting and hopefully crunchy conversation this evening with Tony Locantro, specifically relating to market dynamics, market psychology, and what's been going on and what might be going on and what it means, because there's a really important conversation to be had there. Before I bring him in, I just will remind you that we're not providing specific financial or legal or technical advice. It's a general conversation only. We moderate the chat, but feel free to throw your questions, comments, suggestions as we go. And if you would like to get my attention, if you use it all the world, that'll make sure I see it, and that'll go to my queue. I've enabled Super Chat, which means you can get your question to the top of the list, or indeed make a contribution to what we do around here. Really appreciate those who support us via the Super Chats, via Patreon or PayPal. Really helps just to keep this show running. We don't do this for profit. We do this because we think there's a really important conversation to be had. With that done, let me bring Tony straight in. Tony, welcome back. How are you?
Fantastic, Martin. Great to be back. Certainly been a very exciting year for us. And it's good to be back on the show every few months, and hopefully there'll be a few little takeaways that viewers will remember and maybe apply to what they're going through in life at the moment.
Well, I think it's a really important conversation, Tony, particularly now. And, I called this show the market psychology ups and downs, because markets have been, all over the place. And just to give you a bit of a flavor of that, here are a couple of snapshots of recent shows that I made. I sort of talked about a wild ride to nowhere as markets bite back, with the AI question very much to the fore now, and of course Bitcoin, crashing and burning, at least for now. Earlier on, I made a show called "The Bulls Are Getting Airsick as Reality Bites," and I made another show about the rising global volatility driving markets low on tech valuation concerns. So there's a lot going on, and just to give you a little bit of a flavor of a couple of things that I found quite interesting. Of course, with regard to Bitcoin, there's now some speculation about whether, in fact, the Bitcoin thing and the falls are somewhat related to JP Morgan taking positions on a company called MicroStrategy, and that has dropped dramatically. And so the question is this big players crunching small players? And in fact, this is the MicroStrategy share price, right? Dropped dramatically because what they were doing as part of their treasury operations were buying Bitcoin on the way up and holding them, and then effectively having to sell them because of the price pressures. We also know, of course, that the Genius Act came in at the beginning of the year in the US, and everybody thought this was about crypto regulation. But in fact, as this particular post shows, there's a lot more to it, particularly about the way that stable coins are now forming a significant structure within the treasury operations of the US. What that basically means is they can create more liquidity without going through the Federal Reserve. And the big numbers are involved there. Oh, and of course, just to give you another flavour, the news this week, a third of Australian families are food insecure. The NDIS is being pared back to the bone. Welfare recipients are facing punitive new laws. Meanwhile, we've got this $368 billion to buy nuclear submarines that may or may not arrive. And the last point, just to sort of on the way in, and look, governments have drastically reduced building homes. This is some interesting data from Greg Jericho, which shows that effectively we're building a lot less for the public sector. It's all down to the private sector now. And then here's the final take up. Look at the inflation versus the wage price growth. So in Australia, people are actually getting crunched. Wages have not really chased the CPI very well. And of course, the CPI understates. So we have a significant dynamic. We have market resets going on. We have concerns about the underlying structural momentum within markets. We've got families struggling with putting food on the table and with inflation still bubbling. And what I'm worried about, and this is where I wanted to get your take specifically, is people I think might be overreacting or maybe underreacting to the market dynamics. And the big guys are playing one game, but I'm worrying that sometimes the market psychology is forcing other people to make rather poor decisions. You are the best person I know to talk about market psychology.
Well, I think honestly, I started my working life as a police officer, so I spent 8 years doing that, and since then, I'm coming up to 28 years as a small cap speculative stockbroker. So I have a saying that fear is temporary, greed is perpetual, and human stupidity is infinite. And I would have probably one of the largest databases of fear, greed, and stupidity going round. And there's actually an example coming up, Martin, where one of our stocks went vertical, and the conversations were certainly tough. And what I want to make it known to everyone is that even people taking lotto style wins, they weren't happy with it. They just weren't happy with the win. And there's a quote I've got coming up. And it's funny how when you're working hard, you're delivering these returns. Admittedly, it's been a shit market for the previous 3 years, but I just got to know human behavior so well. And hopefully going through some of these slides, there'll be some worthwhile examples, and I'm certainly going to give viewers something to think about. So I've put together a bit of a slideshow if you're ready, Martin.
Yeah, well, let's just go that. I want to make just a couple of quick observations on the way in. A couple of people have asked me about the naming conventions. Yeah, YouTube messes around with this. Sometimes it comes up with the actual formal name. Other times it's the username. Unfortunately, I've got no control at all about it. So it is what it is. We'll just have to work with it tonight. And I apologize for those who are a bit confused by that, but it's nothing I've done. It's YouTube and their wonderful ways, which I always feel a bit helpless. There are things I can control, there are things I can't control. And YouTube is a good example. And I feel a bit the same about the market, Tony, that, there are things you can control, but there are also things you can't control. And therefore, it's pretty important to understand the difference between the two. So I'm going to switch across so that you can go through your slides as normal. I think it's a great way to get going, and then we'll have a bit of a conversation and discussion afterwards, and we'll take questions at that point. So there we go. You have control.
Okay. Obviously, the disclaimer, guys, this is general advice. It doesn't take into consideration your financial situation or your level of risk. I will disclose stocks that I certainly hold throughout this presentation. So this is probably one of the greatest quotes of all time. Many probably would have saw it on the beginning of The Big Short, only a movie I think I've played about 30 times now, more of a bit of a background movie, but certainly a quote that people should absorb. But I guess, as they say, you don't know if you're stupid or you don't know if you're dead, but it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And I think that's one of the most pertinent quotes when we're dealing with markets in the current environment. Now, this chart is the Dow Jones Industrial Average. You've seen that pretty much since 2021. We're now up at just under 47,000. Again, that market is wildly overvalued, and that's just the Dow stocks. That chart will show that, yeah, we had a bit of a correction earlier this year, but the direction again has been in a pretty healthy northeasterly direction. Here's a chart of the S&P 500, largely dominated. There's actually 503 companies in the S&P 500, but you'll often hear quotes about the Magnificent Seven, probably extended a little bit, and certainly a lot to do with the AI bubble. But again, that chart not far off record highs on the S&P 500. So when you look at that chart, you look at the Dow, anyone playing the short side has been in for a bit of pain. And I know that Michael Burry, when they shorted the US housing market, it took them a while to be right, but eventually they were right, and in a big way. So what I've been doing over the last month, I've been accumulating the BBUS ETF. This can be, it does have a high level of risk. You just can't buy it and stick your head in the sand. You do have to be active with it, but it will provide, in the event of a correction on the S&P 500, it does outstanding liquidity. Now, the fund is designed to increase between 2 and 2.75% for every 1% the S&P 500 falls, and vice versa. So what I do suggest for some clients, based on their risk profile, is to buy this. And the way I saw this instrument, ETF, off its lows, to me was one of the most obvious doubles on the market that I can see. And I've made sure that not only have I taken out portfolio insurance. Look, I deal in small cap stocks. I don't have any blue chips, and I see it as a good way to have a bit of insurance with this ETF. There are other ways that you can go short against the US market, such as SNAS. That bets against the Nasdaq. You can use some other instruments, but the point is you can lose 100% of your money on those through time decay. So based on psychology, markets are overvalued. They're in nosebleed territories. We haven't been this high since .com. Some are arguing way back to 1929, and that's got to play on the psychology of investors. And looking at our market, in the blue chips, I miss the days you could go and buy a computer share for $10. You could buy the banks cheaply. Our banks, Commonwealth Bank, up until recently, probably still is, the most expensive bank stock on the planet. Coles and Woolies were trading like growth stocks. There is just no value in the large cap stocks at the moment. Some will argue that they're grossly overvalued, and I agree with that. And that provides a bit of a conundrum for retirees, those looking for yield. Again, this might lead to Telstra eventually breaking out. But I'm struggling for value in the blue chips. I do deal in small cap industrial stocks that have decent growth profiles, but again, a little bit risky. So what often happens in what I do for my main role, some stocks turn into what I call red-headed stepchildren. And probably one of the best psychology courses I've got over the last 6 weeks has been a biotech stock for my clients. I've had some as well that pretty much has gone vertical. Now, I floated this company about 5 years ago. They had two drug programs. The first one, an LDL cholesterol program, that failed safety. The Narada share price then collapsed to 1.9 cents around 2 years ago. Probably a little bit over 2 years ago. This was under 2 cents. And over the last 2 to 3 weeks, the share price hit $1. So I've just come out of probably the craziest 6 to 8 weeks of my career, and every phone call, I admit, was a bit of a struggle at times. Getting people to take profits, finding out who wants to hang on. But this stock, when something goes vertical, you know what I tell my clients is when there's a speculative blow off, you have to let some go, because when it's very, very hard to sell any asset on the way down after a speculative blow off. And I know many in the stock market that tend to stick to blue chips wouldn't have seen something like this, but I can assure you that, yeah, we were selling. I've learnt my lesson from years ago. I actually put some selling up at 99.5 cents personally. The reason why I put some selling up at 99.5 cents was there's a psychological wall at even numbers, and that selling pressure was heavy at $1. You need to go below that level. And the other key point is when it comes to taking profits, I go against the norm with clients. I suggest you buy odd numbers. Don't buy 50,000 shares. Buy 46,666. Go over that, because holding odd numbers in the event of a speculative blow off makes it easier for me to get you to take profits to round down your holdings. Then we struggle thereafter, but you need to take profits. And what I've found, and I've continued to find over 28 years of dealing with these gains, is this. So what pretty much ruins the enjoyment of a multi-bagger is selling it and watching it go a little bit higher, or not getting the best price of the day. I just think speculators, investors need to be grateful with what they get and go back and think about, well, what you paid for the stock. If you were lucky enough to get the stock at 2 cents and you're able to sell at $1.50, you nailed it perfectly. You played it like a Stradivarius. But this is a tough game. You're never going to know when. No one ever rings a bell. And I fear that for many are holding on to overpriced assets. And when they start to fall, that's when you're going to see a wave of selling come in. Those that think that they've got diamond hands and can hold all the way. But I can tell you, there's no more stupid feeling. You get really down on yourself after a speculative blow off. You think the run's going to go forever. Then suddenly there's a 40 to 50% correction. And that's exactly what we got in Narada. Hit $1, then all the way back to 54, 53 cents. Now it's back up over 70. But for me, you still have essentially a binary outcome. Even though they get through the safety, they're now going to move into safety and efficacy. And I must admit that since I've become a carnivore, I'm a little bit less concerned about LDL cholesterol. So I'll just make that point, but that's a subject for another chat. So how I see the markets, it's a bit like this, to be honest. Cue the Benny Hill theme song. That's what people were doing. You can see that massive euphoria where buying comes in, and you can tell that the buyers are just there to try and push it to a key level. I've seen this throughout my career when there's been a major biotech breakthrough, when you've seen a major precious or mineral discovery. But I think on the whole, from my experience, markets are a collective of people, to be honest, with no frigging idea what they're doing. And that's where you get an ecosystem. We all feed off each other. You have long-term holders, you have traders, scalpers, those that do the IPOs. But I think at times you can cue this theme song, because that's exactly what markets are like. and I can see only this stupidity extending well into other markets. So I'm just going to give some brief stocks to watch. I'm only going to give a small number of stocks to watch for the rest of this year and early next. First one's Maronan Metals. I should disclose that I was instrumental in the IPO of this company. They are an emerging silver lead producer in North Queensland. They did have I did IPO the company around at 20 cents. They did have a run recently when the silver price broke out. They went over 45 cents briefly. They then used that opportunity to raise $16 million with institutions at 35 cents per share, and we're now trading at 30.5 cents. Now, often when you get placements, large capital raisings, you do get new shareholders involved. Not every shareholder is aligned with our interest of holding this share through the medium and longer term. So they'll look for a short-term profit, and when they don't get their profit, they've then got to protect their capital loss, and now the share price is below what they raised at. I think this is one of the highest quality emerging mining companies on the market. I'm heavily invested personally, and I paid full total odds for it. I haven't been awarded any cheap shares, and so everyone's interests are aligned. The second stock is Saturn Metals. Actually, they flew me out on a light plane on my birthday to go have a look at the site out of Leonora. The land's flat, there's good infrastructure, they're close to major power and water. There are some other companies in the region. To me, this is one of the highest quality emerging gold companies on the market. But I will disclose, everyone, earlier this year, I think it was in January, there was a major US fund liquidating their shares. I spent 2 to 3 days non-stop on the phone buying as many shares as I could off this US fund, and the price we got most of them was 18 cents. We then went into capital raise, an SPP at 21.5 cents, and they've since raised money at 58 cents, and they're now trading below it. So whilst the share price is obviously above what we paid for the bulk of ours, I still see some decent growth ahead. But I think it's worthwhile disclosing that some of my best work as an advisor happened when I managed to get pretty much everyone set that listened to me around 18 cents. Many clients have since been happy to pay around 40, but there's very few companies with the quality of this gold resource. It is low grade. It is a potential heap leach operation, but certainly one to watch next year. Third stock, I love the hunt of exploration. I love major discoveries, and I've made this. I will disclose that I am dollar cost averaging this company. I've started with an initial holding much larger. So every time I get paid, I'm going to buy a few $1,000s worth of this stock, and I actually got paid today. So I bought some more shares today, and I think I paid up to 22. But my view is that you can only do this in companies that don't have debt. Obviously, there is a lot of risk involved with dollar cost averaging everything, but I would not recommend that to many people out there because it is a junior explorer. The young guys that run it, Chris Byrne and Thomas Wall, I've been to a lot of conferences. I've met a lot of people in the industry, but these two guys, honestly, if they're not the emerging stars in the mining industry, then I give up. They're smart, diligent. They've built an ideal model with this company. And whilst a lot of junior mining stocks have to fight for every cent, I'm thinking when this one runs, it will certainly run like a Kenyan. So that's one I've been buying personally. I have paid a bit more. to me, I'm there for a major discovery. They've got the big joint ventures with the likes of Rio, and they've got some great ground, and they're going to build a sizable gold and silver equivalent resource. So one of my favorite quality juniors going forward, certainly one stock to watch next year. Red metal, I should disclose that myself and clients, we've bought about 12% of this company. The company's been listed since 2003. It is cyclical. They do have a rare earths deposit near 20 k's from Mount Isa, which is just under 5 billion tonnes. They are doing column leach testing on it, and this will hopefully lead to a scoping study. They have some other joint ventures. They're after chasing elephants. And the other interesting aspect with red metal is that they hold about 35% of the issued capital of Maronan. So based on their share price and market valuation, the enterprise value of this company is about $14 million, which I think is too cheap. Fair enough, it is a bit of a days of our live stock. It does go dance sideways quite a bit, but I've seen many stocks in that 10, 11, 12 cent range that have gone on to dollars that were considered to be boring as well. So they're the four stocks. Please note that obviously I am invested personally in them, and that extends back to the BBUS ETF. So look, I don't buy the gold producers. I looked at the share price of Northern Star, closed at $26.29. In 2010, I actually helped raise money with Bill when Northern Star was 5 cents. Obviously, to hold it from 5 cents to $26 and change, you would have had to have been in a coma or in prison with no Wi-Fi. So I think honestly, the best result out of Northern Star, one client put 7 grand in, he pulled 1.2 million out, and he still talked me down on a TV I was trying to sell. And so again, and he buys me coffee once every 6 months. So these windfall profits don't really change you in the long run. And still, he's pretty casual, but I think the guy's happy. Gold and silver. Wow. Silver has been my favorite precious metal for some time. I've tried to get everyone that would listen into silver. And I think that's a great picture there that Grok drew. So let's have a look. The gold price is a bit higher at the moment. It's over 4,100, but that is a stunning yearly return on a 1 year basis. I'm looking at the US dollar gold price here. 5 years, again, a great performance over 5 years. 15, you can see that the gold price didn't do a lot for some time. Between 2010 and 2022, it was quiet, but now it's pretty much gone vertical. And I can just imagine the psychological impact now from those that watched it dance sideways, and they're thinking, well, should I jump on? Should I increase my precious metal holding? Which is quite a question to ask. So I've compared, that's from goldprice.org. We've had a look at the performance figures. As you can see, that silver over the month has greatly outperformed gold, and it's strongly outperformed gold on a 6-month basis. The figures get closer about over a year and 5 years, whilst over 20 years, gold's been the ultimate performer. But very strong performances from precious metals. I talked to a lot of people out on the conference circuit, and they're wondering, well, what should I be doing with my physical? Is there going to be a time when gold stocks are going to outperform the physical price? Because based on my knowledge of stock market bubbles, I can say that gold and silver stocks have not outperformed where the spot prices are at all. And I think many of them are still even in that undervalued territory. And people should be cognizant that when the gold price peaked around 1980 in the late 70s, around 1980 that the stocks did take time to catch up, and eventually they went apeshit. So now I'm shifting to the property market, and I think these two images are going to cause a lot of people psychological damage. It was fortunate that both those came up on X, and I had to laugh. Someone took a real photo of the Mount Druitt house, which showed the outlook and the real lawn and the curb. So looking at that, to pay that amount to live in those areas, they are the rougher areas of Sydney. I know them. I've been out there fairly recently, and I think I do have the experience about some of the rougher areas in Sydney because I was a police officer in Sydney for 8 years. Admittedly, I started off in Bondi, and I bought my one-bedroom unit in Bondi for $115,000 I paid, or 2.4 times my police salary, and I lived walking distance to the police station and the beach. To live in that house in Mount Druitt, you're paying 14 to 15 times earnings. Let's even say $100,000 earnings. That's 13 and a half times. Add stamp duty, add the threat of rising interest rates. So this is the situation which has just become, I think, psychologically damaging to those just emergency services workers, junior police fighting, working shift work to pull 120 grand a year, can't even live near their work. There's no hope of rentals. I just think everything's gotten out of sync with reality, to be honest. And I think these two house sales pretty much sum that up, and they sum up a hopeless situation that we're faced with. And it gets even worse because today I saw Lewis Christopher. He's put out his forecast for 2026, and again we're looking at 12 to 16% increase in Perth. That should take us comfortably over 1 million. He's even added the Sunshine Coast, Gold Coast, and Mackay there, because at one point I think the Sunshine Coast now is the most expensive real estate in Australia. And now, based on these figures, Sydney is heading towards a median price of $1.9 million, or 19 times price to income earnings. And you're looking at pretty much Hong Kong levels there. And the psychological damage must truly be immense. And what I see as a trigger is, once prices start to fall, I think investors are going to head for the exits to try and offload all their properties. And to be honest, it's going to be like trying to suck an ocean through a straw. And I think you've got a lot of investors holding on, trying to ink out the last of the capital gains. But I think that's certainly going to be your trigger. And those figures, again, they look ugly. I see Lewis gave himself a 7 out of 10 for his forecast for 2025 thus far. But we can look at what's happened. Obviously, Labor lost arguably the unlosable election. And then I doubt anyone had a global pandemic with lockdowns on their bingo card. But there is hope, guys. There is hope. Our friends over the ditch, New Zealand rents are falling. They've pulled the reins in on immigration. Those numbers are falling. Rents are falling. And again, it will lead to further price corrections with property prices in some areas down over 20%. So I think we have to look to our Kiwi cousins for inspiration on what can happen. Now that again is going to play on the thought process of people looking to enter the housing market. Do they go in now or do they wait? And we've even got some conflict here with interest rates, where the head of Westpac is saying 2 rate cuts in 2026. Matt Comron from the CBA is saying no rate cuts next year at all. And I know actually November 19th, 2021, I moved into my house in Perth. I took the view that interest rates could not go any lower. I locked in 5 years at 2.64 and I've got a year left. So at this point, I'm not worrying about it. I know that anything can happen in that year. I'm certainly prepared for the increase in the mortgage. But again, there will be some people coming off 5-year fixed mortgages, and that was such an attractive rate. And I didn't fall for the bullshit that was being spread, that people were saying that interest rates will never rise again during our lifetime. I could see what was happening. I took the risk and fixed it. Will I fix again? I've just got to sit and wait. But if it means having to work harder to pay off the mortgage, that's so be it. But I've been very fortunate that I did fix for 5 years, and that dilemma is going to be facing a lot of people, a lot of young people. I think have to go away and factor in the average mortgage rate, which up until the pandemic was just over 9%. You need to factor that in. If you can't afford that, if your life's going to be hell on that, I think that should keep many out of the market. And again, the attraction to risk building a new house in this market, the building risk, the planning risk, the completion risk, and interest rate risk at the top of the market, I think it's a risk that many shouldn't take. Unfortunately, for others, you just simply can't sell your overpriced house and move into a cheap rental. They don't exist either. So I think a lot out there in the property market especially are stuck. Some brave ones might elect to sell and ask to move in with the in-laws. Who knows? But abnormal markets call for abnormal measures. And I think that's what the thought process of many out there, they have to consider it. Otherwise, you do not want to risk bankruptcy to get on the property ladder at the top of the market, where you might not get a rate cut next year. Those on these early start loans are then going to be forced with higher interest rates. I just think it's a shit show, and a scenario where many out there are going to get sandpapered to death. And already in Perth, we've become the most unaffordable place to rent 2 years in a row, where the average income spent on rent is now in stress levels or at 32%. So over my 28 years, this is only a handful of the bubbles and fads I've seen. Now, all of these, most of them will have a use. I'm not saying that they're a fad, but what I'm saying is they've caused stock market bubbles. .com, alcohol home delivery, retractable syringes, I think, which was one of the themes in Boiler Room, which is worth seeing. Childcare centres had a bit of a bubble. Roll-up accountancy firms, from potash, iron ore. Who thought coal was sexy? Yep, there was a bubble. Bank stocks, bubble. Geothermal, bubble. Apps, you name it. Now we go down to property. Massive bubble, regional bubble, sea change, tree change bubbles, crypto shitcoins, NFTs, millions of dollars down to virtually zero. Buy an image of an ape smoking a cigar, lose your money. Cobalt, rare earths, all useful, but generated stock market bubbles. And then we go down to niobium, rhodium, platinum, palladium, gallium, one of the biggest mothers of bubbles, of all bubbles, AI. Yes, AI is going to have a lot of use. It's the way of the future, but stock market valuations are out of sync with reality. Michael Burry famously has shorted the AI sector. In the near term, he might look wrong, but again, same thing happened with his housing bet. And we go to one of the biggest bubbles I've seen. It's made a little bit of a comeback, lithium, but normally any bubble ending in IUM ends in this, ends in Imodium, and often you see the last come to the party of any stock market fad or bubble. It's like showing up at 3 a.m. to a piss up holding a vegan pizza. No one wants it. And that's it. You end up with overpriced assets. You end up with NFTs, shit coins you possibly can't sell. You end up with stocks that aren't worth anything. And I think, unfortunately, Grok's imagination actually drew a reasonably attractive vegan pizza there, but still, you get the picture. Late to the party, no one wants it. All these fads have caused pain, and the last fad, it always ends with Imodium. That's all.
Tony, thank you so much. And as always, a very thoughtful and thought-provoking set of slides there. And I just want to come back to one of the things that you said, because what you've highlighted is a whole sequence of bubbles, right? Bubble here, bubble there, bubble there. Now, what I'm trying to get to here is the bubbles are being created because of effectively the lemmings all run off in one direction and say, right, that's where the next big thing is. But when you look carefully, what you often see is some of the big players are front running the bubble. They take positions, and then just when the markets are actually reaching their peak, they're the ones that take the short position and sell and basically leave that particular bubble then to the retail investors and to the latecomers who are then left holding the baby. And what I want to know from you, Tony, is that bubble psychology and the split between the big guys and the small guys seems to me to be the most critical thing to understand. And yet I don't get that a lot of people do see that. And, when the talking heads are talking about what to do, they've already taken their positions ahead of what they're saying on the TV.
Oh, absolutely. It's a dog eat dog world out there, and you are playing against big institutions. You're playing against these funds where some of these positions are only 1 or 2% of their total worth, and they just couldn't give a flying as to if they have to liquidate or they're only going to make a certain amount of profit. And it all goes back to fear, greed, and human stupidity. Often when things are running, we're convinced that it's the new paradigm. What did that guy said Fisher said in 1929 that stocks have reached a permanently high plateau. Some idiot said in 1901 that everything that could have been invented has been invented. Human beings are stupid. We just want to follow. We want to feel comfortable. We want to feel part of the herd. But the advantage I see for small investors is you can be very nimble. And if you have a deep understanding of some of these growth opportunities and markets, you can make a lot of money and you can move quickly. Larger funds aren't as nimble, but geez, once they sell, once they think that they're at risk of a capital loss, they're going to bury a lot of these assets. And again, Buffett said, when the tide goes out, you see who's been swimming naked. And I think that's going to happen. And you look at the number of shit coins on the market, it surpassed the number of religions. It just zoomed past the number of religions. And of course, we know, guys, every religion is right. So this is just going to go on ad infinitum. We're not going to learn the lessons of .com. We're not going to learn anything with a website. All these valuations, some other businesses such as Amazon, Meta to an extent have been built, and many don't believe it, so they don't get involved. And you just have to know the rules of what you're playing in. I know that gold and silver are going to get whacked around. I know that on a daily basis, our gold and silver stocks are going to cop volatility, but I've got a rough idea what some of these companies are worth in the future, and we just have to stay the course. And I can tell you, I have a saying with my clients, when the ducks are quacking, you have to feed them. And by that, I mean a speculative blow off in any company, because you have to deal with that. And we know that there's people don't know anything that we don't know. People assume that everyone's got this inside information. That's not always the case. And we make up all these theories on what's happening in the market. A lot of it's conspiracy theories that don't exist. Some of it obviously is real, but we can be nimble, and we can dodge a lot of this damage if you know what the hell you're doing. And any asset class is dangerous. And again, my greatest fear, property especially, is when investors start to unwind their positions, because they're going to be selling into an illiquid market, and that's going to turn it's going to turn into ugliness personified. And that's what we're going to get, because this isn't a new paradigm. Admittedly, the can's been kicked, the flat soccer ball has been kicked far too long, but when it starts to unwind, I have this saying again, it's going to be like trying to suck an ocean through a straw, because the greatest risk for many families now is getting in over their heads, buying an asset that's not worth that. And you have to remember, it only takes a few properties in a couple of streets, and you have a 20% correction on your hand. And that's can be said about any asset. And the hardest part about selling is on the way down. That's a very hard thing to do. And I guess many out there would start looking at, oh, how much I paid for my stamp duty, what's my break even point? And I can tell you that a lot of properties, a lot of overpriced, shitty assets aren't going to get anywhere near what people paid for it. And that's sad, but that's life in finance.
And just on that, there's an interesting comment here. I thought volatility creates opportunities. I think that's what's worth unpacking a little bit, because I suppose there is a mentality about trading, which is taking positions and then unwinding those positions and retaking those positions, and people who might hold assets for a longer period of time. From a psychological perspective, from a market perspective, how different is the trader view of the world and the investor view of the world?
Oh, extremely different, Martin. I dealt with a lot of day trading, short-term trading during the dot-com bubble. The only winner was me with my brokerage. I used to day trade for some clients. I've now eliminated day trading completely and ultra short-term trading. To me, it's gambling. And if you need to get that hit of dopamine, you need to feel the adrenaline. You're an addict. You're an addict, and there's no such thing as a good pokies machine player or a good blackjack player. You're gambling. Now, I'm totally cognizant that some people out there can set up these trading systems and they can make a living trading, and they only have to be right, arguably 5, 6 times out of 10. 51% of the time, they have to be profitable. But to me, life's far too short for that level of stress. And occasionally you're going to get hits. But there are disciplined people out there. There are computerized trading systems that can do it. But what I've found over 28 years of studying human psychology, dealing with fear, greed, and stupidity every friggin' day, sometimes 100 times a day, is that the most successful people in the market are position builders in quality companies prepared to sit through the volatility and at times make use of that volatility. Sometimes you might have the highest quality asset and the share price will drop from $1 to 50 cents. Not the company's fault, just the usual market process. And these people can make use of that. And the other area which is critical, the difference between a trader investor is I teach my clients about portfolio construction, how to weight their portfolio. Sometimes the lower quality stocks are going to outperform, but I think once you learn, I'm still learning 28 years in, that if your portfolio is set right, fundamentals always come to the fore. And every company I've been involved in that's had solid fundamentals and management has delivered, if not delivered, over delivered or being taken over. So it's now I see it. We've had our massive dopamine rush. Our share, one of these stocks has gone from 2 cents to $1 in a couple of years. Now it's the ocean is calm, and I think now's the time for accumulating for the next run, and then that's what I'm doing. And suddenly, I've gone from 100 phone calls a day to 3 if I'm lucky. So investors can sit out these quiet periods. They know that if you spot another Ramilius, you spot another Northern Star, another Regis, I've been there. I know what these companies look like. I've been heavily involved with them, and now I can say to my clients, this gold stock feels like this. This, I believe you should hold this many multiples of where it's trading now, but you're going to have to stomach some 30, 40, 50% corrections along the way. Other stocks, as I said, when the ducks are quacking, just get the fuck out. Sell, please. I beg you to sell. Get rid of that rush. Calm down. Just don't be afraid to sell. As I said, it's the fear of watching a stock go a little bit higher that stops people from taking a windfall gain. And again, I remember the phone call. I was ringing a client, and I know what the guy's like. And I'm saying, look, I'm going to be straight up with you. This is going to be an unpleasant conversation. And I was trying to get him to sell a reasonably small parcel of a stock that just went 12 times for him. I said to him straight up, I know this is going to be an unpleasant conversation. Well, Jesus, guys, get your dopamine elsewhere. I get my happiness and dopamine from meat and paddle. I don't drink anymore. And it was funny. I was talking to Juliana about, how can I celebrate a win? And I said to her, look, I just don't want a new car because I couldn't be bothered looking after it. I like to be able to just chuck my paddle gear in, go to the beach, park without the fear of a scratch. Maybe I'm just getting too old, Martin, but I don't know. And the other saying I have is sometimes you've got to jump out of the Lamborghini into a Lada. The hardest time to jump out of a stock is when it's fast moving, but have a break. Talk to your wife, talk to your kids, turn off social media, go get some bloody sunshine. But there's no harm in selling a fast moving stock after a win to jump into something slower, put something aside for the ATO. Again, that's the stock market. Property, a whole new shit show, because again, you're going to be dealing with an illiquid asset, because once buyers step back, there's not going to be enough of the market to dump in, and that's when it's going to get very ugly. So psychology is fascinating. As soon as I see a phone number or a name come up, I know what the question's going to be like. But every financial bubble, every speculative bubble, I think I'm getting better as an advisor. I'm not perfect. I make mistakes, but what I say to people is, I'm here to provide you with the best chance of making a lot of money. But along the way, you're going to have to get slapped around. There's going to be a lot of stuff you don't like reading on social media. There's going to be a lot of conspiracy theories, legal action, you name it. But the path, you just can't step into the ring and not get punched around the face, because certainly it's tough. And, this year has been probably a year of recovery for us. Uh, I actually looked at one of my clients who listens to me 90% of the time, and I think he's up mid 40s. Other clients are up a bit higher. Those that don't listen or stick their head in the sand don't do as well. But it's certainly been tough. And I know in my business to have 3 tough years in a row, and once you even apply how long the bear market went on in Perth, some areas not that far from the city, you bought in 2005, 2006, and 2016, 17, you're still underwater. So once an asset comes off the boil, good luck trying to get out.
Yeah, and a couple of questions from the audience that just worth exploring a little bit. So Andrew asked about Pack Gold. From
Yep.
memory, that's one you used to support. What's your
Yeah.
thinking on that at the moment?
Alice River project looks good. They've switched into antimony, which has been a bit of a hot metal with the what's been happening in China. They have raised money around these prices. Again, I was involved in the IPO, and the stock went to $1. Uh, Many probably thought it could keep going. So probably a company. Look, I'll admit we didn't properly cash in on based on that first run, but management certainly trying. Share price just below 6 cents. I think it's a worthy hold.
Okay, that's interesting. Thank you for that. And Jason asked an interesting question. How do you see the Trump tariffs affecting the market and Trump more generally? Is it a factor in your thinking, or is it noise in the background?
Well, as you can see, when I pulled up the S&P and the Dow chart, his mouth can certainly move markets, but I think that it's going to have less of an impact now because people are expecting him to retract it. I just don't think he can mouth off and expect the market to say, look, this is the way you're 100% going. For me, many are probably a little bit tired of that narrative. And what it could get down to is markets simply getting tired and a correction snowballing. You don't always need a pin to pop a bubble. So look, obviously we worry about it. There's a fight now for rare earths. It's what's happened with Trump and the restrictions on rare earths has been an absolute boom for Australia. So we've got to be mindful of that. So whilst a lot of stupid things come out of his mouth, um, he can be positive for markets. But I'm just wondering, is he probably more worried about what's going to come out of the Epstein files?
Absolutely. Well, that's a good question. Now, there was a comment that you made earlier on about dollar cost averaging, and a couple of
Mhm.
people sent me messages saying, "What does Tony mean by dollar cost averaging?" Can we just go through the basics of what this is about?
Oh, certainly. So it's a process where you might regularly invest, say monthly, and you buy at whatever price it's trading at. So you might buy some units at 10 cents. Next month you might pay 15, then you might buy 7. But the aim is to end up with a lot of shares at the time when it goes hopefully 4 to 5 times up in price.
Yeah, and the point
So it
and the
is.
and the point there
Yeah.
is
So the
is
point is to obviously build a solid holding over many years.
yeah.
Ideally, I probably would have liked to have done it with red metal, but I haven't. And my view is I've got a limit on what I buy, what price, and I'll just keep accumulating that asset. Probably one of the handiest things I've got my kids onto, is the Raise app, where you invest a weekly amount and you can have a conservative or an aggressive portfolio. And for me, that's a similar. because you're coming into markets that are lower and higher. But it is obviously a highly risky strategy if the company goes under. So you've got to be really careful about what companies you do. Over the longer term, you would have had some obviously success with the likes of Commonwealth Bank, BHP, maybe not as much with Telstra. So I'm just trying to accumulate small amounts of companies on a regular basis. Obviously, I will have to find another company to do that, because you don't want arguably 100% risk. But if I look at my portfolio, some of these companies are carrying that sort of risk. Anyway, BBUS is probably another instrument I'd like to dollar cost average. You can buy that for under $3. Earlier this year, we were able to sell that around $6.80. But again, the longer term, always over the longer term, stock market indices create new highs. So you have to be mindful that you need to use these instruments to make use of a correction. But when the market's correct, it does provide upside and liquidity. And again, you've got a lot of people out there that would be dollar cost averaging silver. If you could dollar cost average silver, if you went back to the time where Warren Buffett sold all his silver for, I think it was about $4.75, all the way up now. Now we're over $50 US an ounce. Because, in those days, he had fears over digital photography wiping out the silver market. So you can dollar cost average silver, you can dollar cost average gold. But I'm now with the view that you've got forecasters out there saying the gold price is going well beyond $5,000. That can be at times the trigger for a correction. As I noted, I was MC at the Australian Gold Conference, and the tone was very bullish, but shortly thereafter, there was a little bit of a correction, and that can be daunting to new entrants into the market. But these gold conferences are certainly valuable for getting everyone's insight and just getting to meet companies, and you can set your BS detector. But that's often where I find a lot of my absolute gems. And I go back to 2023, Gascoigne was sitting there trading at 11 cents. To me, it felt like a Dominion Mining. Dominion Mining was a gold company that had multiples of the value in tax losses, went 29 cents to about 6.80. And Gascoigne ended up going from 11 cents to over $2 and is now part of Ramilius. They got taken over. So occasionally you will find a gem at going to the conference, but you should be mindful that most of the people there are bullish. I guess it'd be like going to a crypto convention or a property convention. But again, you just have to get out and talk to people, meet people, and get involved. But the way I see it is, with major indices in nosebleed territory, the Australian market arguably isn't as overvalued at the US, but there's not a lot of value. People are now going to have to start taking a higher level of risk, and that could be the next fad. Who knows?
Absolutely. And it's fascinating to me in the chat here. I've got, people saying that this is NASDAQ trader. I day trade. It's not gambling, on one side of the fence. And then you've got Jason saying, I agree. Day trading is hard. Lost heaps day trading crypto. I now hold and I'm much better off. And it's fascinating. It's a learning experience, said Jason. And, a few other people are also saying, been there, I don't do it now. And I think that's fascinating. And it shows to me that there is a fundamental dichotomy in terms of people's psychology, right? About what they're comfortable doing and what their success rates have been. And there's no simple one-stop shop answer to how to actually navigate these markets at any given point in time. And there will be people who will be much more comfortable at taking positions, doing a bit of work, and holding, like Buffett, for value over the long term. There'll be others who are more trading and taking positions and trading those positions. And potentially, what I find fascinating is that both can actually end up doing okay, but there is a very, very different psychological profile, it seems to me, for those two sort of mind positions. And the other interesting observation is, of course, your attitude to risk and your attitude to losses. And this is something that I've been very interested in, because over time, markets go up and to the right generally. Not surprisingly, because more liquidity is being created. Central banks are printing more money, the government is lending more money out, etc., etc. So there is more liquidity flowing around the system. So that should be an inflationary force that should ultimately flow through to company profits and therefore to markets. But of course, it's not linear. And therefore, if you are actually in the trading realm and you see an opportunity because of the volatility, you may well take it. If you are actually a holder of positions and then prices start to slide, you've got to then be clear in your own mind about whether this is a stock that still has momentum, potentially later, or whether there's something fundamentally changed. And I think the AI story is a good example of that, right? Because there are people now questioning the basis of AI in terms of, well, can I get access to power and water? And, well, what is the depreciation cycle on these AI data centers that are coming through? And how does that change the game? And will we get value from all the AI investments? And particularly if you're like an Oracle, having to borrow big to be able to actually invest in the AI story. So there's a bunch of questions. And what I find fascinating is that if you're a day trader, some of those strategic macro questions are less relevant. You're just looking at the momentum and the charts and actually taking positions and using the tools to do it. If you're actually somebody who's taking positions and holding them, then you need to have a greater understanding, perhaps, of some of these more macro trends and some of these other issues, and sort of understand where there are turning points in markets. And I think those two psychological profiles are absolutely fascinating, but they're very, very different.
Oh, absolutely. And people that have to trade for a living, most of them would never take a position home overnight. They do not want to be prone to US markets or Trump opening up his mouth. So if traders can sit there and scout small profits all day on pips to make a living, that's part of the ecosystem, because longer term investors, position builders are going to feed off that. And it's often volume that comes into a stock that will allow those position builders to make some exits. So it's at one giant ecosystem and we all feed off each other. And I think that's fantastic. So I say that discount stockbroking, people staying at home doing that themselves for under $10 a trade, I think that's fantastic, because it brings in a whole new large amount of investors, traders, speculators. Many of them wouldn't have a clue what they're doing. They're just chasing momentum. But you've got others that are taking advantage of the increased liquidity, the volume, and the attention on the stocks. So, look, don't get me wrong. We've had some shocking years. Over the 28, there's been some horrible years for us. Years where, many of us are forced to get out of the career, seek secondary employment, change. But for me, I believe I've worked out a formula that works. I'm working, I work with clients to get where they are, but it's never a straight line. And at times, you're going to see your portfolio value decrease, increase exponentially as well. But it all gets back to your bottom line. And as I mentioned earlier, I hate even numbers. People seem to want to hang on to 100,000 shares, even if it's increased 10 times in value, when you should be letting it go. You need to just focus on the bottom line. And you can look at the level of risk that we take. You can look at the level of risk that a trader takes. What level of risk does a first home buyer in Mount Druitt for $1.3 million take going to the ninth biggest bank in the country, the bank of mum and dad, and exposing the whole family to going bankrupt. That's ridiculous risk, but that's the norm. That's ingrained in society that you must jump on the property ladder and you must pay 14 times average earnings for quick access to a meth lab. Come off it. You know, we're not that we're not that friggin' stupid. DFA viewers are not stupid. If you want to go out and buy something like that, try and rent it out, open it up to students, go put 11 locks on 11 doors and rent it. Good for you. If you want an Airbnb, good for you. All this sea change, tree change. You don't have to get involved in an overpriced, overheated market that's going to expose you to bankruptcy and daily financial stress. Again, it's just not worth it. I just think that young people today coming through, they all blame the boomers. Well, fair enough. You look at the rises they've had, they argue that at one point they had 18% interest rates, but again, they were paying 3 to 4 times the average salary. I know my dad did it. He bought a nice unit in Manly Vale for about 12 grand. Terry Hills, we lived in Frenchs Forest. We had a beautiful house in Frenchs Forest. And arguably that's the barometer, one of the barometers, as Tarek will say, of the Sydney housing market. But you don't have to get involved in an overheated market. You don't have to get involved in gold and silver stocks. You do what you think's best. And if you don't know what you're doing, get help. And I think probably the main thing you need to do is have trust. I think trust is everything, because I can assure you that at times during my career, I'm going to look very bloody stupid. And when things go right, it was everyone else's idea, or they didn't take it. So as I said, you just can't win.
Absolutely right, Tony. And one last question before we round this conversation out. Somebody sent me a message saying, "What's Tony's view of passive versus active investing?" Because you are clearly an active investor, right? You go after opportunities and you seek them out and you kick the tires on management and you say, yeah, I think that's going to fly. There are, of course, more and more people effectively using index funds as a way of investing. And I was just interested in again, going back to this the psychology of investors. Is there a different psychology between those who actually go for the index funds and those who actually are more on the side of seeking value opportunities? Because it seems to me that those two thought worlds are actually quite different, not least because, of course, if markets start to fall, index funds have to sell.
Have to sell. Yeah, I think the key difference there, Martin, is that I admit I'm a speculator. I'm looking for growth. My model is I need to find a company that's 400-500% upside potential, 30, 40, 50% down. That's my model. That's what my clients pay me to do. A passive investor in index funds, well, it's going to replicate the index. I think if you've got a long-term dollar cost averaging approach, that you're going to be buying these units in the ETFs a lot cheaper over many years, and eventually you will get the bottom, and then they'll go up. But what's to say that markets won't stay flat for a decade? What's to say we won't have a decade of no rampant growth? So ETFs are good, like a gold ETF, holding gold companies are good until everyone wants to sell. And again, it gets back to trying to suck an ocean through a straw. So it depends how active or passive you want to be. But passive, for many people, just buying a blue chip portfolio, collecting the dividends, has provided outstanding growth. But now markets are stretched, valuations are stretched. I think you need to look for value at the moment. And there's always a chance that ultimately that the gold stocks, eventually their performance will be much better than banks, and they'll start paying dividends and people will hunt for the dividends. And there's a saying that which is true. There's been no greater destruction of wealth than in the hunt for yield. So every asset investment carries a level of risk. I go for growth. I'm mindful that there's going to be some very lean years for us, but if we get them right and when we get them right, it pays off. But I love the thrill of the chase. I love raising money for these companies that are investing in potentially life-saving biotech breakthroughs. I like funding companies that find a mine and generate jobs. That's what I like doing. I don't want to be sitting there with a computerized trading function. I'm old school. I like to handwritten notes. I like to get out and meet people. I'm just boring, I guess, but in a way, but I've learned over 28 years dealing with human psychology what works over the long term. And if people can do it scalping pips, day trading, good luck to them. If they can go out and find land and put four townhouses on it and clean up, good luck to them. But I think you're going to see once asset prices start to fall, you're going to learn who your friends are pretty quick.
Absolutely. Well, I think a certain degree of uncertainty ahead is probably guaranteed based on what I see at the moment. But it is fascinating, and you touched on it, but just to underscore the concept of portfolio construction and thinking about the way that the assets are actually spread across different asset classes and indeed across different stocks, for example, is pretty important. If you don't have time to do that, or indeed want to engage around that, then maybe passive is a simpler way. You
Yeah.
have to still pay a fee, of course, if you've got ETFs, and those fees can add up. But it is fascinating to me how, again, this psychology is so different. I guess as we come to the end of the show, there is no one simple right answer to this whole story of investing or making money on those sorts of things. What you do know is that the markets are actually a huge factor in the way the global economy works. We know that 75% of market value is sitting in the US, which tells you something about what the US influence will be globally. You've also got opportunities in other places, Australia, etc. And you've got these different asset classes and these different, gold and silver and the AI story, all those things. So it's an interesting, and one of the reasons why I make these shows is to help highlight to people that there is no simple answer, but the more you learn, the more potentially you can benefit from that learning. And Tony, what I want to say to you is thank you very much for sharing your insights and thoughts this evening. As we close out the show, any last messages to our viewers at the moment?
Well, I'd say again, batten down the hatches, look at your spreadsheets, spend some time with your partner over a nice cup of coffee and go through stuff you can get rid of. Just cut some costs, get rid of. We've all become complacent with streaming services and all our subscriptions. Make that your first step. Then look at where you might like to invest. Look at if there's something that you could flog, sell a couple of investment properties. I don't know, but the key to selling is when no one really feels like selling, and that's the joy of it. And I guess just be a good person. I've delivered many lotto wins to people. It doesn't, honestly, it makes them happy for a bit, but generally it doesn't change you. So just get on with it, I guess. But hopefully you can all have a few takeaways today. I've certainly outlined exactly what I'm doing with my own money, obviously at a high level of risk. So all I can say is what an interesting time to be involved in this show when asset prices are at nosebleed levels and we're now searching for value. Unbelievable.
Absolutely. And just one little question to end out. Uh, Tony, did you take a game off rafter in a paddle tournament recently? People want to know. Just summarize that for me.
That's Yeah. So yeah, I entered the Australian Masters. I flew to Melbourne. Uh, that my office said that Locantro will pay you $200 if you win a game off Pat Rafter. And I can tell you that I've never had that level of dopamine and adrenaline flow through my body when I actually took a game off Pat Rafter in a game of paddle. So
Excellent. Well, Tony, thank you so much. As always, always very entertaining and interesting to get your perspective. I know that people were very appreciative in the chat. I'll look forward to catching up again in the new year. I'm sure that the next few months will be extremely interesting and probably unpredictable as well. So it'll be fascinating to catch up again next year. Thank you so much for this evening. And I'll wish you good evening and take you offline and close the show. Thank you very much.
thanks, Martin. Thanks, viewers.
There you go. Well, I hope you found that interesting and also educational as well. I think there's a really, really interesting conversation there that we've had specifically about the psychology and the fact there's no one right psychology. Just said next week, Damien Classen's back. We're going to look at the markets over the last month and talk about what's running up to the end of the year. Is the Santa rally going to happen or not? That'll be interesting and hopefully informative. And the dogs are here. They've hardly moved at all. Well, they have moved a bit, but, they're still... They've just sort of expanded. I'll move the camera slightly so you can see them. There you go. So I think the next thing there will be a walk for them. So thank you very much for spending time with us this evening. Thank you very much. Super chat as well. Jason, always appreciated. Thank you so much. And I'll look forward to seeing you all in the next live show next Tuesday, or check up our recorded shows in the meantime. This is Martin North from Digital Finance Analytics signing off. We'll see you next time. Take care.